everyone, and welcome to another episode of Real Estate Industry Update. I'm Kim Hardy, and I'm a director here at James Moore & Company in the real estate segment. And I'm with Suzanne Forbes, who's the managing partner and the real estate segment leader. Today, we're here to discuss purchase price allocation when you're purchasing or selling a piece of property. So, Suzanne, can you give me a little more of a descriptive idea of what exactly we're talking about when we use the term purchase price allocation in this setting?
Yeah, that's a great question, Kim. So when we're referring to that, often a client will just say, hey, I purchased a commercial building for $1 million, and what's my depreciation deduction on it? And we have to go back and look at the total purchase price plus all your cost to purchase and determine the different classes of life that the asset is in. So the most common breakout is the difference between the land and the building component.
Okay, that makes sense, 100%. And so is this type of purchase price allocation, is it relevant for both the buyer of a piece of property as well as the seller?
Absolutely. And I often talk to attorneys and get the closing statements, and I'll say, hey, did you guys discuss purchase price allocation? And they'll say, no, because we didn't want to screw up the deal. And the reason why is a lot of times what's good for the seller is bad for the buyer, and what's good for the buyer is bad for the seller from a tax standpoint on the allocation. So, for instance, a buyer may want less allocated to the land and more allocated to the building and maybe the equipment in the building that they're purchasing if it's a piece of commercial property. The seller would want more allocated to the land, nothing allocated to the equipment in the building, and the balance to the actual building itself. So the allocations tend to be contrary to each other from the standpoint that what's good for one is worse for the other.
So that's interesting that you bring that up, Suzanne, because I know when I've worked with clients who have purchased a trade or business that may even include a building that they're buying or selling, but it also includes intangibles such as goodwill or maybe inventory. I know that there's a reporting requirement with the IRS that both in the purchase of a trade or business, both the seller and the purchaser have to fill out a form. It's called the 8594, and that they would both have to match. And so the IRS gets this reporting statement that shows, yes, we both use the same allocation on our tax returns. Is that something that happens when you purchase and sell just a piece of real estate?
Interestingly enough, as of now, the IRS has not required a reporting by both the buyer and the seller of how they're allocating the purchase price in just a piece of real estate that doesn't have an active trade or business component to it. So if you're just buying the real estate, you don't have to allocate the two. I was just actually talking to another partner today and found out that one of our clients just got an audit notice because the buyer allocated the purchase price. They actually made a mistake on the purchase price allocation form that went to the IRS, and it didn't match, and it triggered an audit by the IRS. So those are business activities. This is not what we're looking at in the real estate. So in a perfect world, you would want them both to agree, but I would say 99% of the time when we look at purchases of just pure real estate, there's been no discussion of the allocation of the purchase price. And so at that point, it's really up to the buyer to make their best efforts on the allocation as well as the sellers.
That 100% makes sense. And that's really what I've seen in practice as well. So from a purchase perspective, why is this purchase price allocation important for the purchaser?
So if I'm a buyer, I'm the purchaser of a piece of real estate. What's important to me is how, when I buy a piece of property, if I buy a building for $1 million, I generally do not get a deduction for $1 million the year I bought it. It doesn't matter if I financed it or not. It has nothing to, some people will say, oh, I'm going to finance it, so my deduction will be different. I'll be like, no, how you buy it doesn't matter. Whether you pay cash for it or you finance it, doesn't matter. What matters is what the IRS says is the requirements for how you write off this purchase of this building for $1 million. And the IRS says you have to write it off over a set of lives that they give you that are prescribed that have nothing to do with reality. And for example, one of the things they say is that land doesn't get depreciated. So in the eyes of the IRS, land never gets written off. So if you buy just a piece of raw land and you don't, you let's say you're running your business and you're using it as it's a piece of raw land. It's filled. There's no pavement or anything on it. You're using it for a parking lot. You're not getting a tax deduction for that land, not until you turn around and sell the land. But if there's a building, the IRS says, okay, that building is declining in value over time, so it allows you to write it off. The purchaser, the buyer, wants to be able to get generally as quick a write-off on this building as possible so that they can reduce their current tax liability. That's when it becomes really important to know how you're going to allocate between what your land is or your building is in this example, because if you allocate more to land, you're not going to get a write-off on it until you sell the land.
That I understand. It seems like even so, if it's allocated to the land, you don't obviously see the write-off for a long time. It must be until it's sold. But even the 39-year, which is my understanding is the depreciable life for a commercial building, even that, it seems like it just takes forever to be able to write off the cost of that building.
Right. So if you buy something, for $390,000, I'll just use my math simple. That means you're getting, if I do my math right, $10,000 a year deduction. It's going to take you 39 years to be able to write off the value of that building. And that's assuming it's all building and there's no land to it. So it is important because the deduction is what reduces your income. So if you have rental income and then you offset that by your depreciation, that's the number you're going to pay tax on. The net of whatever your income is less this deduction for depreciation under the IRS code. And so you definitely, as a buyer, are looking to be able to get as much deduction as soon as possible to offset your income.
Okay, that makes sense. And how about from a seller perspective then? Why is this allocation important?
So from a seller standpoint, they want to know what tax rate they're going to pay. If it qualifies for capital gain, it's going to be potentially at a maximum rate of 20%. But if it's not capital gain, then it's going to potentially be at a 37%, and there's a 25%. There's all these different rates depending on how the purchase price is allocated. So if I'm selling something and I've got $1 million gain on it, it seems like that $1 million number, and I'm paying a 20% tax, that's $200,000 versus a 37% tax, that's $370,000. That's a difference of $170,000 in my pocket after taxes. And so it will matter. So from a sales perspective, depending on how I allocate that purchase price, depends on how that gain is going to be taxed. It's not that simple anymore. You can just say, oh, everything's going to be at capital gains, because there's varying rates depending on how we allocate that purchase price.
Oh, I understand. And so it doesn't really change the total amount of your gain. Obviously, just as you're recognizing that gain, what tax rate different components of it will be taxed at.
Right. And that's what we try to sit and advise clients and say, well, if you allocate your purchase price, this, based on this for the land, this for the building, this for the equipment or whatever, and you're the seller, this is the impact based on the tax rates, and this is what your total tax would be. We can even go through a scenario and say, let's allocate it a different way, and let me show you the net tax impact. And so you can understand exactly what the difference is going to be.
So let me ask you that. So when we originally started talking, we talked about this purchase price allocation for buying a piece of real estate with a building on it. We talked about it being land and building, but you bring in an interesting factor that you may have something like equipment or furniture, or even maybe there's components in your building that under certain circumstances might qualify for a different life. So is there a way to actually allocate part of the purchase price or sales price to those other components?
Yes, and it's actually pretty common. There's actually something called a cost segregation study, which will break out the components in a commercial piece. I'll use a simple example of let's say you buy a residential rental, a house, a
Hmm.
single family residence. You might actually have some components like a refrigerator, a washer and dryer, a dishwasher that are much shorter life than the residential property itself. And so you might have a significant land improvements. You could have a residential property. Let's say it's waterfront. Now you've got a completely different situation because a lot of the value of that rental might be in the land,
Hmm.
which can't be written off until you sell it. So you definitely want to go in and look at components. And then there are for cost segregations and can get even more sophisticated, like the paving in the parking lot or the drainage improvements and anything that's done outside to the property. Those all have potentially a 15-year life. So it might even be as basic as coming in and looking at how many spaces there are and what is the cost of the parking lot. We see parking lot and swales and drainage and a lot of outside improvements to property that do qualify for a different life.
Uh, it's really interesting you bring up the fact that you might have a piece of waterfront property. So like I live here in Tampa, and there's a lot of properties that have kind of skyrocketed in value, especially in the current market, the way things have been. And so there's many homes in South Tampa and probably across the state and across the country that have have been increasing in value. My question to you is, if I have a piece of property, let's say it's on the waterfront here in Tampa Bay, and the value of the property in total has gone way up, it's on the waterfront, and I purchased it for maybe at a time when Tampa Bay wasn't really booming like it is right now, the allocation that I might have used when I purchased the property, let's say 20 years ago, might be very different from what I believe the allocation between land and building would be now. Do I have to use the same allocation method that I used when I purchased the property?
That's a good question, and the answer would be no. You want to use a reasonable method. If you're getting down to, the perfect world, you'd actually get an appraisal of the land versus the building. It may be that land values have increased at a
Mm-hmm.
faster rate than maybe building construction has increased. In your example, if you bought a piece of waterfront property many years ago, so that may be a reason why you wouldn't allocate it the way you allocate up. And then you're talking about a seller, somebody that's selling the property. Is not necessarily the same method as to how they allocated it when they bought it. And a lot of times we'll look at that because the benefit, they're actually from a seller standpoint, I mentioned earlier, the more you can allocate to land in a sale, usually the better you are off from a tax uh, rate standpoint. So those are definitely factors to consider. And if we get into a really large sale where these numbers become really big, then it might make sense to get an appraisal or have some method of making sure that you can support your allocation.
Right, right. Let's say that an appraisal isn't really cost effective. In some situations, you might be talking about a smaller piece of property where to get a formal appraisal, it may cost more. Um, what would possibly be some other options to figure out what that allocation is? Are there any other possibilities that you could use?
Yeah, I mean, the most common one we see actually is using the tax assessor's allocation. So if you
Okay.
go into your property tax records, usually the tax assessor will allocate a value to the land, to the building, and any improvements. Their value usually on the tax assessor's website is less than the total, but you can use that ratio
Hmm.
of what the land is to the total or improvements or the building. So that's usually what we'll see a lot of times, unless it's really, really wrong, unless you have some reason to believe that it doesn't make sense. I mean, the IRS, in my experience with any type of inquiries in this type of situation, pretty much will take that if you're using that. So if it's a reasonable allocation, it seems right to you, then that's what we see. And even sometimes when people get appraisals, on the issues we have with appraisals, a lot of times you might see an appraisal because of the getting bank financing. So if
Right.
somebody's bought a piece of property, I'll ask them, they got financing? I'm like, can you get a copy of the appraisal? The problem with those appraisals is that usually they appraise the value in total, and they don't necessarily always break down the land versus the building. Sometimes they'll have the building cost, like what it would cost to build the building, and then you got to try to depreciate it. So what you're trying to do really is just have a reasonable method, and you do it when you're doing the actual allocation. And so it's in your file, it's part of your records, and you say, okay, this is what I used and why. And as long as it's reasonable, and you have some basis for using it, usually it's not going to be an issue in an IRS audit.
Okay, well, that's really helpful information. So it's real important to document what you're doing, why you did it, and
When you're doing it, not when you get audited, but when you're actually doing it. I mean, that's something we help our clients with, is helping them get that documentation together, and it's done when you actually make the decision. So it's not like you're coming back, oh, I'm being audited and I got to go get this information to support what I did, 10 years ago. They want it to be supported when you're making the decision.
right, yeah, because that would not be fun to have to deal with that 10 years later. So that would be quite a struggle. So yeah, so thank you so much, Suzanne. I think this has been a great conversation.
Well, I hope it's helpful for all our listeners out there, our clients and others in the industry, because it is a common thing. I work with real estate agents, and I work with attorneys all the time talking about how important this purchase price allocation can be. And when our clients call us and ask us, hey, I want to sell this, what they want to know is, how much net am I going to end up with in my pocket after I pay taxes? And sometimes we're not in the position to answer it because we haven't addressed this issue of how we're going to allocate the purchase price and figure out what tax rate your gain is going to be taxed at. So I think that's really that's the takeaway for anybody out there. Either buying, if you're selling, that's usually what you want to know, and if you're buying, it's even more critical because that's your future cash flow. It's improving what you're going to be paying on an ongoing basis over a period of time in taxes.
Yes, I 100% agree.
Well, thank you, Kim. This has been hopefully really informative for our listeners.
Thanks for joining us today. It's been a pleasure to speak with you about purchase price allocation. Please be sure to subscribe and join us next time.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.